Good morning. My name is Robert Misey, and welcome to what I hope will be a continuing series on various international tax aspects of the 2017 Act. Today, we're going to talk about the fundamentals of the participation exemption. The participation exemption is the centerpiece of the 2017 Act. This is the provision that's going to result in U.S. companies being more competitive overseas. At the same time, they're going to be less likely to want to invert because they'll be more competitive. Okay, participation exemption only applies to C corporations. Doesn't apply to individuals, doesn't apply to S corporations, doesn't apply to LLCs or other type of pass-through entities. In the past, pre-2718, U.S. companies had to pay full vote, an effective 35% rate of tax on their foreign earnings that were received as a distribution of a dividend from a foreign sub. So in my simple world, earnings and profits are income less foreign income taxes. There are a lot of accountants out there who are much more attuned to what goes on in determining E&P. For our simple purposes, it's simply going to be income less foreign taxes. Before 2018, we had draconian deemed paid foreign tax credit. I say draconian because it was draconian. I almost never said deemed paid foreign tax credit without the word draconian. Kind of like when you watch the Masters golf tournament, it's never the green jacket. It's the coveted green jacket. You hear it so many times, you'd think that coveted green would be a shade of green, like forest green or Kelly green. Forget about my digression. Let's go back to the example. So in the United States, we'd have a dividend, and we'd have this gross sum of 20 of the foreign taxes brought back with the dividend for 100. Pre-credit U.S. tax of 35, we get the draconian deemed paid foreign tax credit of 20. The end result is we pay residual U.S. tax of 15. That's the residual tax. But the 15 to the United States, the 20 to the foreign country, that's 35. On the other hand, say you had not U.S. co, but CanCo going into foreign country, that dividend would be exempt from Canadian country tax. Lo and behold, the centerpiece of the 2017 Act, this participation exemption, now starting in 2018, there is not any United States tax. This is going to make us more competitive with other countries. So let's talk about some of the particulars about the participation exemption. Only applies to the foreign source portion of a dividend. You might be thinking, well, what is the foreign source portion? Typically, dividends from foreign corporations are entirely foreign source unless they have over 25% of their income U.S. source effectively connected income. There's a holding period. The holding period applies for 366 days during a 2-year period starting the day before the ex-dividend date and ending a year after the ex-dividend date. I want to skip ahead to point number 6. We are not going to allow foreign, I say we, the United States is not going to allow any foreign tax credits. Now this makes sense with respect to that draconian deemed paid foreign tax credit. We now alleviate double taxation through the participation exemption. But now, there's also not going to be any Section 903 credit for withholding taxes. I think that one strategy we might anticipate in the future is if we are in a high tax jurisdiction, we might want to start checking the box. Okay, well, that's all I have for today. Next time we're going to talk about some collateral implications, some planning with respect to the participation exemption. Have a great day.